Hello, this is Jordan, and this video is being recorded Tuesday, September 20th, 2016. Thank you for joining me today. And in this video, we're going to focus on the inflation side of real interest rates. And starting off, this is my master chart of what I consider gold's fundamental driving force, real interest rates. And we have a weekly plot of gold there at the top, and then we have the real Fed funds rate and the real 5-year yield. And as we know, real interest rates are essentially interest rates minus the rate of inflation. So, where are rates and yields going? Where is inflation going? And last comment on this particular chart, you can see the last 18 months or so that the real Fed funds rate in 2015 it was slightly positive, but now it's down uh, to what is that, minus 0.6, something like that. And the real 5-year yield at one point in 2015 that was nearly 2%. It's come all the way down to basically zero. So that's been the driving force of the new bull market in gold. And anyway, let's get to the inflation side because the report last week on Friday, I believe it showed inflation ticked up and precious metals sold off because that meant, oh, it gives the Fed cover to raise. But what we really want to talk about is the fact that in the CPI, inflation could be bubbling under the surface. Now, I'm talking about the statistics here. I'm not talking about shadow stats or the idea that inflation is, the cost of living is going up 7 to 10% a year. I mean, we're just focusing on these statistics and not what's happening in the real world, which we know is worse. But anyway, the statistics are important because, I mean, this is what moves markets. And here we're showing something called the sticky CPI. And so this focuses on items that are sticky, which would mean uh, they're not flexible and volatile month to month. So these are items that they tend to be trending for a while. So if something's going up in the sticky index, it's probably going to continue to go up and not change month to month. And the same can be said if something's going down. So the sticky CPI, this thing is nearly 2.7%. We can see that that is the highest since it looks like late 2008. Uh, Now, things that, and let me go to the next picture, and that's the core CPI, which it's not quite as hot, so to speak, as the sticky CPI, but the core CPI, as we can see, if it just goes up a little bit more, that could be the highest since the end of 2008. And remember in the 2000s when inflation was going up, but the headline CPI was always much higher than the core CPI because food and energy were going up. I mean, driven by the bull market and commodities, and other things in the index were not rising as much, were more stable. But interestingly, now we kind of have the opposite effect where the core CPI is going up more than the headline CPI. So the non food and energy things in the CPI are rising than the food and energy things, so to speak. And I mean, what's really been driving the CPI higher, at least the core CPI, the sticky CPI, medical care and housing, that are both rising quite a bit. And basically, the takeaway from this data is the fact that the non-food and energy parts of the CPI, the sticky parts, they're rising, and that is probably going to continue at least in the near term. And if we start to see commodities gain more traction and commodity prices rise, especially energy, then you're going to see the CPI rising quite a bit. Now, um, with respect to the Fed, and we'll just talk about the Fed as we close this video, but interest rate hikes are only bearish for gold if the Fed funds rate and bond yields are rising faster than inflation. And what we see here is that there is some inflation under the surface. And I think the regular CPI is about 1 or 1.5%, somewhere in there. The Fed funds rate is around, it's close to 0.4 actually, the last time I checked the data. So a hike would probably take it to perhaps a range of 50 to 75 basis points, but kind of in the lower end of that range if they do hike. But the thing is with the look of the inflation statistics right now, a single rate hike by the Fed is not going to change the picture of real interest rates, which we see is basically negative for the real Fed funds rate, and then the real 5-year yield, as you saw, I mean that's around zero. So for precious metals really to be in a negative trend, to fall back into a bear market, fundamentally you would need to see interest rates and yields rise much more quickly than inflation, and I just don't think we're going to see that happen. The only way the Fed is going to hike multiple times is if inflation is really picking up. And if inflation really picks up, they'll probably hike once. Maybe they'll wait and hike another time. But I mean, if inflation goes up by 1 or 2%, the Fed is not going to hike by 2%. If inflation goes up by 2%, maybe the Fed hikes by 50 basis points or 75 basis points. With the big debt picture globally, we need to have negative real rates and we need to have inflation to reduce that debt burden over time. And so once we do get inflation, the Fed is going to let that run by not hiking as much as they should. And I mean that has really happened most of the time throughout history, other than in the late 70s and early 80s. That's the only time where the Fed really hiked aggressively and to take inflation down. I mean, if you go back to the 1970s and also the 2000s, remember, especially in the early 2000s, the Fed was hiking, interest rates were going up, but inflation was going up faster, and so that's how gold can perform really well even when nominal rates are rising. So all this stuff, we should keep it in mind. So even if the Fed hikes, maybe temporarily, it might cause some more weakness in precious metals. Um, I mean, even if they don't hike, they could be focusing on a hike in September, and that could cause additional weak. Excuse me, they could focus on a hike in December. That could cause some additional weakness in precious metals. But looking at the big picture here, as far as the inflation component, we can see that it's bubbling under the surface, and once commodity prices start to strengthen, we can probably see inflation perhaps go to 3 or even 4%. I'm not talking about in the next couple months, but maybe sometime next year. So, bottom line is, I'm not worried about a Fed hike here. It's not going to change the new bull market in precious metals. And that's all for today in this video. Thank you so much for following my work. You can follow more of my work at thedailygold.com. Opt in for my free newsletter there where you can get my book, thedailygold.com/book. The free newsletter, I give a weekly update every Sunday where I talk about what research and analysis I'm following during the week, and also I give some snippets of my premium service there. So definitely go to my website and opt in for my free newsletter. Again, everyone, thank you so much for listening and watching, and I wish you all the best. I hope to do another video for you in the next week or two. Thanks.